London Business School is in reflective mood at the moment because it's the 50th anniversary of the school's formation, and closer to home in finance, it's the 20th anniversary really of the creation of the corporate finance programs in their current form and of our Masters in Finance. And so people have been asking me a lot of late, what's happened in the last 20 years? What's changed? And that's precisely what I want to talk about in this podcast. And my story is going to be simple. I think financial statements have got much better over this 20 years, and I'm going to explain why. That will come as a surprise because we all like to criticize rules, and in particular, we love to criticize the accounting rules, GAAP, GAAP. And there are still problem areas in GAAP, but I'm going to suggest that actually GAAP has delivered much better financial statements for us. The real challenge is the way we use them. And I do not think that we're using financial statements better these days. Sadly, despite our best efforts, I think the quality of analysis, of fundamental analysis, has deteriorated, and I'm going to explain why that is. So my challenge for the world is to raise its game in terms of the analysis of fundamentals. Firstly, my claim that GAAP has got better. I think the way to think about financial statements always is to ground them in investment theory. If we're trying to understand the economic performance of a company, what we do is measure the return the company is earning on its investors' capital and then compare that to the cost of capital. So, in other words, at the heart of a rigorous analysis of financial statements is this idea of return on capital. Because we understand that if a company or if any economic activity is to create value for the people who provided the money, the investors, it must earn a return on that money better than the return they could get elsewhere. But that is very demanding for financial statements because it needs the balance sheet and the income statement to have the data integrity that we would expect in a capital budgeting exercise, in a well-organized and rigorously conducted investment appraisal. And that forces us to think about the integrity of the accounting data. And of course, it brings the balance sheet right to the center of things. Well, what do I mean by this data integrity? It's actually quite simple. If we had three things, easy to say, of course, but quite hard to deliver. We had three things: income that's comprehensive, a balance sheet that's complete in the sense that it gives us a complete account of the assets and liabilities of the business, and a balance sheet that measures the opportunity cost of those assets and liabilities. Then that would be all we'd need, and we could rely year on year, period by period, on the return on capital, the measured return on capital, correctly measuring the economic return of the business. And that provides my framework always for thinking about accounting. And it's against that model that I think GAAP has got better, and I'm going to explain why. Firstly, this thing, comprehensive income. I should perhaps explain or remind you what this piece of vocabulary means. The earnings, the net income, the profit after tax, the number at the bottom of the income statement, is typically not a complete measure of the income a business has generated for its owners. For that, we need to look to the balance sheet because there have always been some items that are directly accounted in the balance sheet, and the GAAP is not required to be passed through the P&L. So using earnings to measure return on capital can't reliably give us a measure of the economic return of the business. We always need at least to cast an eye to what we call other comprehensive income, the stuff in the balance sheet, the things, the gains and losses that lurk in the balance sheet. What are those? Well, principally at the moment, most companies we look at, the big items there are to do with currency movements, which can be an enormous swing factor for any international business year on year. Gains and losses on derivatives, and perhaps, and this only applies in the world of IFRS because US GAAP does not permit revaluation, perhaps revaluation. Those relatively few companies that actively revalue their assets will record the effect of that in the balance sheet. It won't go anywhere near the income statement. Now, this had seemed like a rather technical requirement, but very helpfully and quietly in the background, GAAP, US GAAP and IFRS have been pushing companies to bring the other comprehensive income to the fore by requiring a separate statement of it just next to the income statement. And now I'm pleased to see that increasingly companies are combining the two statements. So we're now getting an income statement that is comprehensive. And we've got no excuse as users anymore for ignoring these other comprehensive income items lurking in a footnote. And how about completeness? I think completeness of the balance sheet is absolutely key, because the balance sheet is, after all, the fundamental record of property rights in a market economy. It tells you what assets a company is using and what claims there are on that business from outside. Unless the balance sheet is complete, we can't hope to be measuring the economic performance of a business. And again, GAAP seems to understand this, and over the last 10 years in particular, has made enormous strides in plugging the big holes in balance sheets. A very big challenge around 10 years ago was getting companies to properly record their pension deficits on the balance sheet. Another one was around deferred tax. Accounting for long-term tax liabilities was always very much an optional activity for companies. It's now mandatory. And those two items loom very large in the balance sheets of many companies. There's also much better discipline around off-balance sheet accounting. We recall Enron, and I'll talk more about Enron later, finding a device for simply hiding all the bad news and incredibly high levels of borrowing in what were effectively subsidiaries. They were quasi-subsidiaries, but structuring them so they didn't need to be consolidated into the group accounts. Well, that had always been hard to do on this side of the pond, and under IFRS. US GAAP has now got much tougher on that. So these off-balance sheet tricks, also methods of securitization for receivables, are much better policed now. There's one final big step in terms of making at least the liability side of the balance sheet complete, and that's around operating leases, which still are an enormous off-balance sheet quasi-borrowing liability for many companies. But again, I'm optimistic that quite soon operating leases will come on board. So then we'll have a balance sheet that's pretty much complete in terms of liabilities, and we'll have comprehensive income. And of course, those were two of my three requirements. I think at that point, GAAP will have gone as far as it's going. Because the accounting rules and the people who legislate accounting, the GAAP rule makers, have a fundamental bias to conservatism. We know that. So balance sheets will continue to, as far as I can tell, there's no plan, no realistic plan, to bring missing intangibles into the balance sheet. They'll continue to omit homegrown intangibles. And of course, going to the heart of the valuation question, GAAP will continue to prefer historical cost to current value for recording operating assets. What's the result of this bias to conservatism? Well, of course, it means that equity is understated. But I think my conclusion over the years is that, even though in a sense we might dream of this theoretically complete and current valued balance sheet, we can actually live with the balance sheet we now have, which is complete but determinedly historical cost, as long as we understand it. And I think we do understand it. So practitioners pretty well understand the conservative accounting model and the biases it brings. We know that generally equity will be understated in this world. And that insight's quite useful. If we're measuring return on capital, and we find we have a company with a very high return on capital, maybe a return on capital of 20%, and a cost of capital of 10%, should we throw our caps in the air and conclude value creation? Well, not necessarily. It may be driven by conservative accounting bias, understated equity. But very usefully, if we see a company that's earning a return at or below its cost of capital, then almost without doubt that company is destroying value, because all the biases are upward, given the way accounting works. So, you see, when I congratulated the progress that GAAP has made, it's modified in the sense that I know GAAP will, for its own good reasons, never fully embrace the theoretical ideal, and certainly will never give us full-blown current value accounting for operating assets. But I don't, as far as I can tell, that doesn't get in the way of us being able to usefully use income statements and balance sheets to measure economic return. We just need to be aware of where the biases are. And of course, not everything is perfect in the accounting garden. How could it be? Because the world is full of smart, ingenious people and complex contractual mechanisms, all of which combine to create new challenges for regulators and for rules. At the moment, I think one of our biggest concerns and the biggest challenges for GAAP is revenue recognition and revenue management. That continues. We lack detail. The battlefront is not so much the accounting model, the thing I've been describing, but the willingness of companies to service it with useful amount of disclosure. One clear headache is around segment accounting. The principle is very clear. GAAP, US GAAP, and IFRS say, well, we want companies to disclose a decent amount of detail at the same level of disaggregation in terms of business segments that the top management of the business would use for managing it. Well, looking at financial statements as I do all the time, I just cannot believe that that's what we're getting, because the level of segment disclosure is very thin. The level of aggregation is extraordinarily high. This bit of GAAP clearly isn't working, so there's work to do there, and so forth. But generally, I'm happy with GAAP, and I'm happy with the accounting. That's got better over this 20 years. What I think hasn't got better is the way we use the data. If we go back 20 years, well, this was the heyday of what we call the shareholder value movement. This idea, which has now entered our consciousness, so we barely think about it, that the purpose of business, or it's the driving idea in corporate finance at least, that the purpose of the company is to create shareholder value, to maximize the wealth of its owners, and that central to measuring that is return on capital, was relatively new, and everybody was very excited about it, and it was incredibly influential. So all of the big consulting firms had value management practices, selling this idea to companies, teaching them how to implement it. They developed their own, naturally, they developed their own proprietary metrics, economic value added, cash flow return on investment, and many others. And they did a lot of thinking and philosophizing. Many of these consulting firms published books, which were the sort of books you tend not to see nowadays, but you certainly did 20 years ago, where they were writing about the integrity of the accounting data, exactly how the accounting numbers would need to be measured for EVA or CFROI to provide a reliable measure of the economic return from companies. So, of course, in my terms, this was the golden age. The world was thinking in return on capital terms, and it was driving the world to think about the quality of the data, which for me, as those of you who've been taught by me will know, is the central discussion. And it spilled over to investors because, again, the investment community was very well resourced in those days. both on the sell side and the buy side, everybody was looking to get a competitive edge, and one obvious way to do that was to use this toolkit, the return on capital toolkit, and investors did, both on the sell and the buy side. And in any case, value investing demands a return on capital approach. It's, I suppose, unavoidable. But then came several things, but let's blame some of it on Enron. Enron failed in 2001, and this had a completely unpredicted consequence, in my view, for analyst practice, which was very negative. Because Enron, of course, perfectly demonstrated the need for good fundamental analysis. I read a paper on Enron at the time and reviewed maybe 50 or 100 broker's notes, but written by the greatest and the best investment banks. Hardly any of them mentioned return on capital. Why? Well, I guess because they'd calculated return on capital and found that it was so terrible that in their desperate desire to say something positive about Enron, they had to bin it. We needed people to be publishing good fundamental analysis and raking through the entrails of Enron's return on capital, which is very poor. In the aftermath, Elliot Spitzer, in particular, New York Attorney General, was strongly associated with colleagues in pushing through a lot of seemingly very sensible reforms. One of the problems that we found in the aftermath of Enron was that the equity analysts had been in the pocket of the investment bankers. The investment bankers were getting paid good fees by Enron as long as they arm-locked their equity analysis colleagues into telling a nice story. So Elliot Spitzer, and we did something similar in the UK, imposed Chinese wall down that corridor between the investment banking end and the equity analysis end of the corridor. Very sensible, but unfortunately, I suppose we realized later that that was going to strip all the resource out of equity analysis, because equity analysis had been a very well-resourced profession in the 1990s prior to Enron. Lots of analysts, and the top analysts getting paid extraordinarily large amounts of money for doing their work. Well, without the subsidization from investment banking, equity analysis was going to have to live on its own wits, and the consequence is an enormous reduction in the resources going into equity analysis. There are now observably fewer analysts. Many of the big banks have cut their equity analysis operations by 2/3 in terms of headcount. And those equity analysts are getting, they still get well paid, but they're probably getting paid a fraction of what they got paid in the 90s. And as a result, I think we see much less fundamental analysis and research being published. Analysts have to cover a much broader waterfront. They simply perhaps don't have time or resource to do the deep research that is to lead thinking. So very much, a lot of their time is spent on short-term responses to earnings announcements. And as those of you who try and invest in small companies will know, small companies get hardly any coverage. You know, a small company, a small cap stock is lucky if it's got one analyst, one serious analyst covering it. So there's been a loss of fundamental research. But at the same time, and it's not all Enron's fault for sure, because this predates Enron to some extent. There has, in my view, and it's essentially my personal observation, been a loss of focus on rigorous measurement of income, of return on capital, of cash flow. Why has this happened? Well, maybe the turbulence of the world, the lack of analysis, the lack of resource in analysis, as I said earlier. The world has moved on, and that clearly has other preoccupations. I think the growing importance of technology businesses has been part of the problem, because many of those technology businesses, young technology businesses, are, as we know, loss-making for years frequently. Very hard to plug into a return on capital model What if the return on capital is negative? What should we say then? Accentuated by the tech bubble, which at the turn of the century, and then the deep financial crisis of 2008, all of which knocked the skittles over and made it much harder to tell a robust routine story about financial performance. And I think the exemplar of this, and hence the title for this podcast, is this concept of EBITDA, earnings before interest, tax, depreciation, and amortization, which of course you will be very familiar with, and which I think is very damaging and dangerous for the reasons I will explain. And it perfectly encapsulates the loss of rigor in our thinking. Where did this thing EBITDA come from that we see everywhere now? Well, companies, I suppose EBITDA surfaced as a notion, as an acronym in the 90s, and in the late 90s was embraced enthusiastically by companies. As I said a moment ago, there were a lot of loss-making tech businesses around during the technology boom. And then in the early 2000s, there were a bunch of companies, large international global businesses, who'd consummated very large, possibly overpaying along the way, consummated very large acquisitions around 1999, 2000. And in the early years of the 2000s, finished up having to write off the goodwill. Now that meant that the EBIT of these companies, the conventionally measured operating profit, or EBIT, was enormously negative in many cases. Hey, what a good idea to try and pluck a happy story out of the numbers by ignoring the depreciation and ignoring the amortization. And you know, we can see the logic of that from a company perspective, because an impairment, an enormous goodwill impairment, and some of these impairments, sometimes in the order of $5 or $10 billion in one accounting year, completely mess up your numbers. So let's go to the underlying and let's call it EBITDA. The danger, of course, and I think this is what's happened, is you throw out the baby with the bathwater. Companies started to tell their story in terms of EBITDA. Analysts liked it too. Analysts were desperate for a positive number during the dot-com bubble, given that EBIT and earnings were often negative. What on earth we were going to attach a multiple to? Well, here's EBITDA, which always gives a cheery story. And if I'm to be a little cynical, I think analysts quite like not having to think too hard about the hard things. But of course, those hard things are often the most important differentiators between companies. You know, how much is the true economic depreciation this company faces? What is its tax rate? And what is the effective capital structure? And as I'll emphasize again in a minute, the problem with EBITDA is that it encourages you to ignore these things, even though, especially in a global population of companies, there can be enormous difference in effective tax rate and in economic depreciation. Ignore these things at your peril. There's no doubt that EBITDA is part of the story. I mean, used with care, EBITDA, which simply says, let's look at the surplus generated from revenues accounting for a certain subset of costs, is meaningful. I mean, you can track that number through time, and it will tell you something about the trend in the underlying productive economics of the business. But the problem is, EBITDA is not a measure of income. It ignores a bunch of costs, depreciation and tax in particular, are for most companies two of the largest costs they've got. It clearly is a measuring income. Nor is it a measure of cash flow. I mean, part of the superficial appeal of EBITDA is that, of course, it comes from the cash flow vocabulary. It's part of the cash flow story. But it ignores the investment in working capital, and it ignores the investment in capital expenditure. In other words, it ignores the balance sheet. As always, Warren Buffett put it best. He, a famous critic of EBITDA, when he said, does management think the tooth fairy pays for capital expenditures? Which, if you thought EBITDA was a measure of cash flow, you would. The number you want is, of course, free cash flow, which fully accounts for all of those things. Does it matter? Does this? I'm using EBITDA here as a sort of potent exemplar of what I think has been a loss of focus on rigorous measurement of fundamentals because of this addiction, this cult of EBITDA. Well, I think that is yes, because it's always been a slippery slope. Yes, in its place, EBITDA will be part of the story. But of course, for many companies, analysts and commentators, EBITDA has become the story. And if you think EBITDA is a measure of profit, then you're in trouble, because EBITDA makes unprofitable business look profitable. And this can feed back into internal management practice if you're using it to reward and measure divisional performance. If people have the impression, and I frequently see this when I'm out and about talking to companies, people have the impression that you don't need to worry about the cost of the assets you're using. That is disastrous. EBITDA, of course, is also very vulnerable to creative accounting. Bernie Ebbers at WorldCom at the turn of the century was quick to spot this. He was a famous exponent of EBITDA. He saw that analysts were all preoccupied with EBITDA, so he thought, well, I'll give them EBITDA. So he did this. He simply, if you recall, over a 2-year period, capitalized about 7 or 8 billion of maintenance expenditure and simply called it an asset. In other words, added it back to EBITDA and said, there you are, my EBITDA is 8 billion higher than it would have been. How about that? And why do I say it's corrosive? Well, even people who should know much better, and I would include the big 4 accounting firms in this, have all slipped into the lazy habit of EBITDA. I quite often, for the government, am asked to review due diligence reports on companies. And to my horror, in recent years, increasingly those due diligence reports won't bother to produce a complete income statement and balance sheet for the company, for the company under review. The big 4 accounting firm will simply produce an EBITDA number and say, there you are, that will do. Well, hopefully I've convinced you that it won't. So here's our challenge. Yes, I do think that financial statements have got better over the last 20 years against this template, this sort of rigorous template, comprehensive income, a complete balance sheet, and a current value balance sheet. But it's not clear to me that people are using better. I think practice is in constant need of improvement and discipline. We constantly need to remind ourselves of the fundamentals, of the underlying logic of this game, which is the logic of value creation and of return on capital. And for me, at least, that is the continuing battle. Thank you very much.
Thank you very much, Chris. I think Anne's just going to address a few of the comments and the questions that have been posted during the debate as well. For anyone else still out there, do feel free to post your comments or questions there. You can put it on the chat board if you don't want to just send a message to Anne White personally. But Anne, did you have a few issues you wanted to raise there?
Yes, I'd like to describe. Chris is the academic director of one of our 3 corporate finance modules. He is the professor who covers the accounting and financial analysis part of the program. And with all 3 of these programs, what you receive at the end of attendance is normally a certificate of attendance. These courses are all elective. They are not degree programs. So these are for individuals who are seeking to really expand on either existing knowledge or delve deeper into their current areas that they want to focus on, and hear also about what's happening in the new research. So this is an example of what's going to be covered in class, or sort of the kind of discussions that happen throughout the week. Now, if anyone has any questions specifically for Chris, please feel free to put them in now, and we will bring them up in front of Chris. I'll wait a few minutes. So I think, Chris, maybe you have actually covered this topic completely to everyone's satisfaction. There's one question coming in now. Christopher Son has asked, what are your thoughts on companies using EBITDA CapEx as an internal measurement of FCF?
Oh, that's almost there. Yes, I regularly encounter this. And again, it might be useful if I stepped back. There is this idea around that EBITDA is a measure of cash flow, is it not? Well, cash flow is a story, it's not a particular number. And in summary, the story is this. A company's cash flow starts from profit. The wellspring of cash is earning a profit. We add back the non-cash expenses in the P&L. That's the famous EBITDA. And then what do we do with that cash that we generate from trading? Well, we pay some tax, and we invest in working capital, and that gets us down to what we call operating cash flow. And the final step is that we may well need a big chunk of our cash to buy capital equipment or to buy other companies for acquisitions, and we call that free cash flow. Hence, earlier I said EBITDA is part of the story. Yes, it is. It's up at the top of that page. So for a complete measure of cash flow, we'd need to account for, we could start with EBITDA, account for tax and working capital investment, and deduct CapEx. Now, Christopher, you're saying, how about EBITDA less CapEx? Well, that gets much closer to what we want, and we'll do. And as long as the EBITDA actually isn't EBITDA because it allows for tax, because we must account for tax, and as long as working capital is not very important, which in some industries it is not very important. In other words, the outstanding balance, inventory is relatively a sideshow, and outstandings to suppliers and outstandings from customers are in balance, something like this. Then EBITDA minus CapEx, which is what you're suggesting here, will be a fair proxy. I mean, and I do see that. I see some sort of rational companies using that as their measure, and I'm comfortable with that.
Luciano was wanted to ask, do you think that maybe the SEC organizations, regulatory agencies such as the SEC, should determine how EBITDA is calculated?
Yeah, no, I don't. Well, they could, but I don't think there's any point, because it's not the way it's calculated that's the problem. There are some numbers that are full of ambiguity, and everybody calculates them differently. EBITDA isn't one of those. I think everybody pretty much calculates EBITDA in the same way. It's not how it's calculated, it's what it means that's the problem. It simply isn't a measure of profit, and it isn't a measure of cash flow. So getting it at the SEC, making it a quote-unquote GAAP number, because as you know, and I think this is behind your question, Luciana, the SEC now requires US companies to put a little flag against every reference to EBITDA and signal that it's a non-GAAP number. Well, if they were to define it, then it would become a GAAP number, but that wouldn't solve my problem. My problem is the interpretation of that number, not how it's measured.
And Chirag was also asking, what do you think of industry-specific variations of EBITDA, such as EBITDAR, which is used for relative valuation of telecoms? Do these variations cause more harm than good? Yeah,
they're all fine as long as we keep them within the bounds for which they were initially intended. And the same applies to EBITDA. I mean, carefully used, and what would carefully using EBITDA mean? That would mean using it simply to compare in its own terms one's own progress through history as a company, or one's sort of economic performance or productive performance, perhaps, relative to a group of carefully controlled peers as a benchmark, then it's safe. And the same applies exactly to your EBITDA with an R. For relative valuation of a fundamental stream of income, yes, that's fine. But of course, unfortunately, these measures get out of the box. They're like toxic viruses that can't be kept in the laboratory. And we start believing in them and using them for everything.
In the same vein, Akinola is asking how useful, for example, is another variation, EV over EBITDA.
Same comment. EV over EBITDA, which is almost universally used now by in many branches of the investment community, is of course full of problems, because you're saying, in that case, you're using EBITDA as a valuation, as a base for a valuation multiple. EV, the economic value of the business, EBITDA, a measure of its income. But as noted in the last half hour, EBITDA isn't a measure of income. It's unreliable because investors care a lot about differences in tax, differences in capital consumption, and differences in capital structure, all of which are completely ignored by EBITDA. So it requires an enormous amount of care to reliably parade an EV to EBITDA multiple, in my view. Naturally, I have a strong preference for more disaggregate fundamental analysis of the discounted cash flows sort.
Chris, we have just a few more questions we'll take, but do you think, Minal is asking, should EBITDA be adjusted for stock compensation expense to calculate free cash flow?
Well, no, of course. Strictly, stock compensation is a non-cash item. So it's not in there. And nor would it be in free cash flow. And it reminds us of the limitations of cash flow, however valued, because we know that stock, however measured, because we know that stock compensation for some companies is a very large cost, but it's a non-cash cost. So I think the message, you make a good point there, Minal, and I think the take home from your point is that all cash flow measures, robust ones like free cash flow, less robust ones like EBITDA, all have limitations. Cash is not profit, and actually profit is strictly what we prefer, because not all costs and not all revenues occur in cash form.
And Saulo is asking, or posits, Chris, the data is very complex. So what can we do to have better analysis and still increasing the volume of data? It's already hard to deal with the amount of data on EBITDA.
Yeah, I do have a view on data, and there's a passing reference to it on one of the slides. And by the way, one or two of you have been asking, obviously you can have the slides later. They will be published to you. I think one of the continuing problems in accounting that we face is lack of disclosure. But it's not lack of data, paradoxically. I spent quite a lot of time recently looking at the banking industry. And banking is notorious for the length of its financial statements. If you look at a large international bank these days, it will not uncommonly have a financial report that's 500-600 pages long. The banks blame this on the regulators. I'm a little suspicious myself, because even when if you're trying to compare a panel of banks, you try to do the most basic read across, you find you can't get the data. So there can be a vast amount of data and very little economic disclosure in there. And I don't think EBITDA, EBITDA is a very simple idea. The numbers you need to calculate EBITDA are pretty much on the P&L in one footnote. EBITDA isn't part of the data problem. There is a big data problem. I think you're right, Stella. We got far too much noise in disclosure, and it's distracting our attention from the key economic fundamentals.
And I think we might have time for one more question. It's from Christopher. Would you be able to share your thoughts on what you see as detailed segmental disclosure? You mentioned that GAAP requirement is not working as intended or the level one would expect.
Yeah. And again, this is and I think my requirement here, it may be an unreasonable, because it's clear what's going on. Companies are required by GAAP, by the SEC in the US, the corresponding regulator elsewhere, to use a very simple and reasonable test. In the boardroom, in the main boardroom, what level of disaggregation do we manage our business at? So what individual divisions do we get to report up to the main board? Let's disclose segment balance sheet, highly summarized, of course, an income statement for those at that level of segmentation. It's clearly not happening. And the reason it's not happening is, I suppose, commercial confidentiality. And companies will always argue, and there's some truth in this, I suppose, that they'd be giving away too much information. So they like to bury the detail. So the simple answer to your question, Christopher, is I'd like companies to do what they're asked to do, which is to disclose the segments that they use to manage the business. I don't think they're going to do it because they don't want to. They view it as commercially confidential. And that's a running battlefront always. It's a timeless problem between outsiders and insiders in business. We like more, and they'd like to give us less.
Okay, there's a point as good as any that we can bring this debate to an end. Thank you all very much for joining us today, and thank you very much for your questions and your input. As some of you had joined this webinar when we'd already started, don't worry, this will be made available on our website, so all of you can download that. We can also send you the slides to any other interested parties. We do have some upcoming corporate finance programs. I'm just going to put the dates up on the screen now. So as you see there, you can avail yourself of Chris Higson's teaching there on the 17th to the 21st of August, where he'll be teaching the Accounting and Financial Analysis program in the daytime format. There's also an evening format of this program available for the London audience. Do contact me. My contact details are there if you'd like any further details about any of these programs, or indeed any of our executive education finance programs. So once again, thank you very much for joining us today to attend this webinar. And once again, a very big thank you to Professor Chris Higson for sharing your time with us and also your insights. Thank you, Chris.
My pleasure.